Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Almasri. Nick Van Dyke is a real estate investor that's based out of the Brantford area. He actually lives about 30 minutes south of Brantford, and he is somebody that started off by growing his portfolio locally and eventually dove into the U.S. market like a lot of other people are starting to do, a lot of Canadians are starting to do. So on this episode, we talked about how he was able to grow his portfolio initially by buying smaller properties, single-family homes, duplexes, triplexes, that sort of thing, and then how he's now developing self-storage units in Houston, Texas, and he's also exploring the Florida market as well for that. He's also got 2 short-term rentals in Florida. As some of you probably know, Florida was recently hit with some hurricanes, so a lot of their market was really impacted. The days on market for properties, the short-term rental business, all of that. So for anyone interested in learning how to invest in the U.S., I think this is going to be a good episode for you. If you do enjoy the episode, again, please make sure to share this with somebody you know, a friend, a family member, and leave us a review. That would be greatly appreciated. 5 stars would be fantastic, either on the Apple Podcast platform, on Spotify, or whatever other platform you're listening on. And finally, if you want to download some cool reports, you can go to www.welloff.ca/podcast. There's a lot of freebies for you to pick up there, all relating to or pertaining real estate investing. So I know you guys will appreciate the content. Make sure to check it out. And again, thank you for all your support. There you go. Enjoy the episode. I'm here with Nick. This is the first time he's on the show. I've heard you on other podcasts in the past. It's nice to have you on.
Thanks a lot. Thanks for having me. I know we've been talking a few times to try to set this up, so it's finally good that we're here.
Yeah, for sure. So I like to, anytime a guest comes on the show for the first time, I like to ask them about their childhood. So we'll start there. Just tell me a bit about where you grew up and a couple things you remember.
Yeah. So I guess my childhood, small town country kid, played a lot of hockey, played a lot of, we lived out in the country. So, redneck, hillbilly, that kind of thing. And, growing up, I had a good life. My family was good, all that. My parents were, in my life and everything else. So, I'm happy and all that. But, we came from, I guess, some humble beginnings. So, and then, I went to school for civil engineering, met my wife in high school. We have 2 kids now, 2 little boys. And then through school, I, read the purple book, Rich Dad, Poor Dad. And one thing led to another and wanted to get into real estate. Fast forward, we bought a bunch of rental properties and did some flips and assignments and apartment buildings and, all kinds of things.
Mm-hmm. Yeah, let's dive into that a little bit. So you started off, again, I guess, just for context, you grew, sure. I'm assuming you grew up an hour, or you said about half an hour south of Brantford, right?
Well, I grew up in a little town called Burford. I don't know if you know where that is, but
I don't.
It's one intersection, basically one set of lights. Well, maybe there's 2. There's 2 now, but when I was younger, there was only one. So no Tim Hortons, maybe like 1,500 people at the time. So small country town, just outside of Brantford, a lot of tobacco farms and that kind of stuff.
Yeah. Okay. So small town, civil engineering. Where did you go to school?
In Hamilton at Mohawk.
Okay. At Mohawk. Did you move back after you graduated, or did you stay in Hamilton?
Actually, I lived at home. I had at the time, I don't know what year it was, but 2001 or 2 Volkswagen Jetta diesel. Mm-hmm. And it was amazing on fuel. So I just drove to Hamilton every single day.
Oh, yeah.
So it was, 45 minutes, an hour drive or whatever it was. But it was cheaper to do that than it was to live somewhere. So.
Oh, for sure. For sure. Yeah. I actually had a 2003 Jetta a couple years ago. Yeah.
Yep.
Okay. So let's dive into your portfolio, how you got started. Brantford, I think you said that's where you bought your first rental, right?
Yeah. So we bought our very first rental property. So basically I read the book, Rich Dad, Poor Dad, and, it makes you think a little differently. And, you want to acquire assets and cash flowing assets and limit your liabilities and, have your assets pay for your liabilities and all that kind of stuff, right? It makes you think I guess, not like an employee. So we, went down that road of just like evaluating some properties. At the time, my wife, well, at the time she was my girlfriend, but she didn't really want to get into real estate, the whole story of it's risky and whatnot. So after some persuasion, I guess, and looking at some properties, we found our very first one that we wanted to buy. It was a duplex for like 190 grand at the time. And then we bought that one, renovated a unit, was starting to make about $500 a month in cash flow. And I was like, okay, I can do a few more of these. So then we bought another one, and then we bought another one, and then we, refinanced those to buy a couple more. And then with lovely rules in Ontario, you're dealing with tenants who don't pay market rent, and you got to evict them and blah, blah, blah. So fast forward, we ended up converting a bunch of properties into into either duplexes or triplexes. Because then we're basically, starting from scratch and can pick our own tenants and then, get market rent and whatnot. Then after that, we got to a point where we basically ran out of our own money, and it was all tied up in the properties that we did have. So we started bringing in investors and joint venture partners to kind of continue to scale. And then we just kept on growing.
Okay. Duplex for 190K. That's the first one. What year was that?
So 2013, I think.
2013. Okay.
Yeah.
Were you buying, let's say, roughly a property a year from that point on, or was it more than that?
No, I think the first couple of years we bought maybe like a couple properties a year. Mm-hmm. And then I think it was in 2018, I think we bought like 5 or 6 properties. And then at the same time, then we started, then we picked up a couple flips on top of that. And then we had a couple assignment deals. And just like every year, it was kind of interesting. So my wife does these like little books, like they're kind of picture books, right? So for the year, and it shows you like what you did with your family and your business and your life and, the kids and, whether, years ago it would have been us going on some trips and whatnot. Every year she would put in there, like, what houses we bought. So like the very first, the early books were just like, 1 or 2 houses. And then as we go on, there's like 5 or 6 and then 7 or 8, and it just kind of kept on growing. So,
yeah. When I hear you say you bought 5 properties in 2018, did you keep all of these, or some of these flips, or some of these properties that you assigned?
No, I guess flips would have been on top of that. We did, like, we have, I think it was either 2018 or 2019. I can't remember exactly, but we bought, I think it was 5 properties that like single family homes in the north end of Brantford that we converted to duplexes.
Okay, so I'm sure there's people listening that are wondering, how do you do that? Like, even in 2018, how are you able to come up with the capital to do all that? Was it self-funded? Was this all joint venture money?
That would have been like we raised money or had partners on it. That was after we built like between me and my wife, we bought, I don't know, a handful of our own houses, just like our own, like personally. Then you run into the problem with the banks here in Canada where they say, you have too much debt and we can't use that much income. Or you go to, CIBC says you can only have 5 mortgages, or Scotia says 10, or whatever the case is. Mm-hmm. But yeah, then after that, instead of, taking no as an answer, we just, found a different way to do it. So sure. That's when we started bringing on investors and partners and structuring it that way.
Did you follow some sort of a coaching program, or were you part of a networking group where you learned how to scale your portfolio that way? Or was it just, like, where did all this money come from? Was it just within your network?
No. Like, where did the money come from?
Yeah, the joint venture partners that were bringing in the cash.
No. Well, yeah, like local people, friends, family, people that I knew personally and built a relationship with was the majority of the time where most capital comes from at the beginning, until obviously you build that reputation. But in the earlier years, I bought a property and I was like, okay, that's all great and all, but how can I go and do this again? So, I wanted to refinance and pull that money out so I can recycle that capital. But I was apparently doing the whole BRRRR strategy before that was even a thing. I was just like, I bought a house and I'm like, well, how do I do that again if all my money's tied in? So I need to increase the value to pull the money or to pull that equity out in order to kind of rinse and repeat, right? So, but yeah, the majority of the money that I did raise came from, friends, family, at the beginning, and then, coworkers and other people that you're around,
Yeah.
and then, now it comes like, social media is another benefit, obviously, because you can, it's a modern resume, right?
Mm-hmm. And you didn't, again, like follow any sort of program or have any guidance on how to do that. You just figured it out on your own.
Yeah, that's the story of my life. I just figured out as I go. You make mistakes, you learn, and you kind of improve the next time, right? So
Yeah.
I very little guidance at the beginning. I just did it.
Did you have any challenges with any of your partners, like any deals that maybe, people change their minds or last minute, they don't want to provide funding or anything like that?
No, like I think there's always hurdles in anything that you do. What I guess some of the hurdles that I had to deal with regards to like partners and stuff like that was at the very beginning, I tried to be very clear and upfront and honest and, outline the risk and the reward and all that other stuff, just so that there was no, surprises down the road. But one thing that I learned early on with regards to like partnerships and stuff. So, anyone's listening who's maybe trying to get into their first partnership, I put like at the very beginning, I would usually raise money from investors, and then I would also put some of my own money in. But then I'm also doing 100% of the work. So now looking back, that was a terrible idea for myself because I'm doing way more of the project. I'm running it, whether it's a duplex or a small multifamily flip, whatever. Like if you're doing 100% of the work, but you're also putting in, 25, 50% of the money, but you're only getting out a portion of that. That is a lot of work for what the reward is. But at the beginning, you kind of have to do those things to make the deal work, build your reputation, and, prove what you're thinking to your investors, right? Mm-hmm. Now, I typically will structure it where we have a capital partner and an active partner. So like the capital partner fronts 100% of the finances or the money to do a deal, whether we combine that with financing or private lending or whatever. And then we do basically 100% of like the work. So, and then we split everything up equally. But I found that, with partnerships and joint venture partners and all that stuff, it does have to be a win-win for everything. Like some people have cash, some people have borrowed money. So like if they have borrowed money, it needs to make sense for them if they have to pay the interest on it and whatnot. Or maybe you're refinancing and getting that capital back. But yeah, there's a bunch of different ways you can structure it, but like to simplify it, everybody has to win, but at the same time, everyone has to contribute, I guess, or bring certain things to the table. Otherwise, it can cause like resentment or other issues and stuff like that, which it's not worth it in the long run.
Yeah. So if we go to that example where somebody is using a line of credit to fund down payment or a renovation on a project, and there's interest obviously involved on their end, what's your solution to that problem if someone brings it up to you?
Well, I explained that you're leveraging bank money. It's not your money. Like you're leveraging that to, able to invest in real estate. So, that's one thing you point out. You can structure it in a certain way. Like, we have people that have home equity line of credits they can leverage too. But then, you're running the risk, and now they're paying 7-8% on their HELOC. Mm-hmm. Or if you had, depending on the deal you're working it into, you can have it set up where, okay, this is going to be a 3-year plan or a 2-year plan or a 5-year plan, whatever the case is, depending on the deal. Maybe they secure that funds as a mortgage to lower their rate. So it's a little bit more breathing room, right? Mm-hmm. So I explained that all at the beginning, but at the end of the day, it's like step one is having a good deal. If you don't have a good deal, regardless whether it's cash or borrowed money, like I've figured out that you do not want to just try to make deals work. You want to find the right deal to do, like versus just, justifying, well, this will be good if this happens, or this might be a good deal, like just to make it work, because everyone just wants to do deals just to do deals, when in reality, a lot of those deals aren't good.
Mm-hmm.
So,
Yeah. Yeah. One thing that I've heard from another investor when it comes to somebody using their HELOC funds would be, let's say they have a $300,000 line of credit. Well, maybe if they use 200,000 to invest, then they still have that 100K balance, and they can use that to pay off the interest each month while you complete the project. And then once the refi is done, then they're able to pay off their, as much as the HELOC as you can get from the refi.
yeah, no, you just want to factor in that interest payment, right?
Mm-hmm.
Like, I have a guy right now who's got $1 million of a HELOC, and he's like, you hear what can I do with it? But it's got to be funneled into the right deal, because, his concern is, okay, well, I want my interest to be paid, is one, obviously.
Mm-hmm.
But two, he wants to make some money off of it. Otherwise, what's the point of doing it, right? So when you're running your numbers on whatever deal you're looking at, it's got to make sense that, like, there's enough income, there's enough cash flow, equity growth, whatever you're doing, in order to kind of pay it. Like, whether you're paying interest or a drywall payment, it's still expense, right? So,
yeah. Okay. So before we started recording, you were saying that at this point you're just kind of maintaining your portfolio in Brantford, and I'm not sure if you're investing in other cities as well in Ontario. Can you tell us a little bit about that, or is it just like, do you have some properties that are kind of cash flow negative because of the rate drops, and you're trying to make some adjustments there, or is it just everything's good, you're just coasting?
yeah, like the majority, like, so I guess before the rates went all crazy, so every investor is different. I did everything with like fixed mortgages, just purely because I'm like, I want this payment and I want this income, and it's simple, it's clear, I didn't have to worry. I ran the numbers like that. That way I didn't have to worry about rates and variables and stuff like that. Was that the best use of debt? Maybe not, but I could sleep at night. So what we're doing now, so basically before rates went crazy, I actually did a bunch of blend and extend on a bunch of our properties. So like, okay, rates dropped, but my rates was, say, maybe 3.5% at the time. Mm-hmm. And so rates dropped to like 2 or whatever the rates dropped down. So I did like, okay, I did a blend and extend. So I blended my rates, and then I extended my term out for another 5 or 7 years or something.
Just to clarify, your current rate on the fixed mortgage was higher than the going rate at the time, and you were able to blend it with the lower rate and extend your term.
Correct.
Okay,
yeah.
that's amazing. Yeah.
So we did that on a bunch of properties, because I'm like, what, eventually these rates are coming back up. I have no clue when, but just to kind of protect myself a little bit, why don't I take advantage? I can't refinance the property and break the mortgage. I don't want to do that. Pay a penalty and all that other stuff. So I'm just like, what, let's just blend and extend. We get a lower rate. We can extend it out for another 5 or 7 years. And, we'll just, in 7 years, a lot can change. So that's kind of what we did on a bunch of properties. We did have some problems, I guess, on other properties where, the rates went up. The same time we had to renew some of those mortgages. Fortunately, for a couple of those houses, we had some pretty good healthy cash flow on them. So like, we had a 6-plex that was cash flowing, I think $2,000, I believe it was. Then that went down to like $1,200 after we did with the rate increase and all that stuff. So that ate into that. But then a tenant left, and then we got the rent up. So like it's up again now, but it's not where it was before. And then there's other ones where, maybe not other ones. I think there's one property that we have that's basically breaking even, just because bad timing with the rents and the rate increase and all that stuff. But so I guess when I say maintaining properties, is we're just, we're keeping our properties that we have. We are actually selling a couple, just to kind of free up some liquidity. But when I say maintaining, we're just, things are running, people are paying rent and the mortgage is getting paid for, and, just letting it roll. So and basically I'm not really focusing on buying any more properties locally, just because I have a whole other thought of the price of land and inflation here and all that other stuff.
Yeah. Well, let's get into that then, because this is kind of the next chapter of your life. You started exploring another market. Why don't you tell us about how that thought came to be, and just in general why you decided to look elsewhere?
Yeah. So obviously, I'm a young real estate investor, and I still wanted to continue to grow my wealth and income and all that stuff. So we actually during COVID went to the U.S. For a trip, just a family vacation kind of thing. Didn't have any intentions of buying any real estate, but one thing led to another, and we ended up staying, and we went to Florida for planned a 3-week trip, but ended up staying for a few months actually, just because it was nice. And at home during COVID, everything was shit. We couldn't live and couldn't enjoy your life really, right? So we just stayed. We just continued staying in Florida. So my kids were young; they weren't really in school, and schools were closed anyways. So instead of sticking a mask on their face, they were playing in the beach and going, playing in the sand and stuff. So anyways, we went to Florida. We ended up buying 2 single family houses while we were there. A, we liked Florida, and B, the numbers made sense at the time. With people going to Florida and the demand and all that stuff. So now it's not, I wouldn't say it's bad, but it's not nearly as good as it was. Like the demand, I would say has come down, and I feel like it's just everybody's getting pinched right now with the economy. But that's a phase in my opinion, and I think eventually everything will come back. But yeah, so we ended up buying a couple short-term rental properties in Florida. And then while we were there, I went to a real estate event, talked to a guy who was doing all these self-storage developments. And I didn't even consider self-storage at the time. Like I wanted to get into some bigger projects, like something that was a little bit more exciting. And just started looking into self-storage, and, fast forward, we had a opportunity come up and we bought it. So we ended up buying I think it was around 7 acres in Houston, Texas, where we're now developing a 100,000 square foot self-storage facility. So wow. That's kind of our main focus now. Then we got another one on the go in Florida, and then we're looking at other deals and other opportunities. Mainly Florida and Texas, just purely based on the demand. But yeah.
That's amazing. So are you doing this on your own? The 7 acres, the development there. Did you say that was in Houston?
Yeah. No, I don't do everything on my own. If I guess I don't know if you've ever heard the book Who Not How, but I leverage that, I guess, and have the right people to work with. So we bought, so we started a company in the US called NVDR Developments, and that's basically me and my brother-in-law. So we basically partnered. And I don't know if you've ever heard of a syndication, but so essentially we syndicated these deals. We raised money from investors, and basically we're now developing a facility in Texas. So.
So it's just you and your brother-in-law that are kind of the GPs on it, and then you have people that are bringing in the capital.
Yeah, in a nutshell. So basically, we did like the LP GP structure. Me and my brother-in-law are on the GP side. We do have a couple other co-GP partners that we've partnered with because they've done more deals than us. So we're leveraging them, their contacts and experience and stuff. That was obviously. Like that's a couple of years ago now. So we've built that up and built our knowledge up by doing it. But you got to start somewhere. So we do have a couple co-GP partners on it, and then we have then on the LP side is basically all of our LP investors were the money that we raised. Yeah.
Can we dive into some of these numbers? Can you just maybe share what you're expecting in terms of the cost to build? Yep. Projected returns, that sort of thing?
Yeah. So we we basically bought, I think it was around 7.5 or whatever it was acres in Houston, Texas. And now we're developing a 100,000 square foot facility to buy the land, to the construction, to do it all. Our all in budget's roughly around 14 million, give or take. And then what we do is we raise money for basically the land, the down payment, closing costs, our design, all that other stuff. And then we get construction financing for the actual build. So now we're into it for all in for roughly 14 million. And then we got a stabilized value based off of a feasibility study that we do ahead of time, and conversations with other large management companies like CubeSmart or Extra Space. They're like big REITs that also are in the self-storage industry. So we get like a pro forma and a feasibility ahead of time to say, okay, what's our projected value? I think at the time when we did it, it was around $22 million of projected value. So there was, a healthy spread on the costs versus what it is. With rates that came up, so that's going to impact that obviously a bit. So our value as of today is probably a little bit less, but we're planning on getting it built. Right now it's probably 60% complete right now. So we're hoping to have it done and open in maybe August or July of this summer. And then it's a matter of just filling it up. So, we have 700 units in Texas. So it's not going to just get filled up overnight, unfortunately. We're projecting it could be, 12 months, 18 months, maybe even more. We really don't know until you start filling it up. So hopefully once it's filled up and stabilized, when we go back to the bank to refinance it, we're hoping rates have come down a little bit, which would then, hopefully bring back that return back to, close to where it was supposed to be. But yeah.
Is it something you are planning on keeping for the long term, or is it something you're going to flip? Is it a cash flow play?
Yeah, I think originally I wanted to keep it more just because it was, there's going to be some good meat on the bone. We're going to pull out all of our money and it's going to have some good cash flow. I really don't know yet, I guess. It depends on how good it stabilizes and what the rates are when we go to refinance. So we'll have a better idea then. Regardless, if we did sold it or if we did sell it now or at CO, we'll still be able to give a really good return to our investors. But if you can own an asset and refinance that cash flows and have nothing into it, why get rid of it, right? So that's kind of where we're at with our thinking. But time will tell, I guess.
Yeah, fair enough. So if you do hold on to it, do you have a certain cash flow projection?
Yeah, I think it was close to around 200 grand for cash flow after all the expenses and stuff like that. So how we structure our syndication is if you're an LP investor,
and sorry, just to clarify for anyone listening, in case you don't know, LP is limited partner and GP is general partner.
Yep. So when we're doing our syndication, all of our investors or LP investors on that side, we pay out a pref payment while we have their capital, and then we give them a percent of equity. So for one, we sell it out in shares. So one share represents 1% of the deal. So if they invest, 100 grand or 200 grand or whatever the structure is, they get 1% of whatever value we create. So during the time they get a pref payment, when we go to refinance, we pay back the capital. Then we hold on to it. It's stabilized. So out of that $200,000 of cash flow, they technically get 1% of it. So if it's 200 grand, they get $2,000. If it's 300 grand, they get $3,000. And that's, on an annual basis. So we just basically mail out a check every year and that's their part of it. So, and then obviously there's the equity side of things too. So.
Yeah. Okay. It sounds like a pretty good project. Must have taken a lot of time to structure everything. When did you get started on that? What year did you start? And then can you just give us a timeline of how things progressed?
Yeah. So usually I'm trying to remember when we did start. We started, what are we in now? 24. So in September of 23 is when we would have started our construction. And then maybe 8 months before that is probably when we bought it. So it might have been even a little longer, something like that. But we bought it. Usually there's about 8 to 12 months of like design, and your due diligence and actually like ironing out what you're building. Cause there's, as simple as a storage facility is, like, there's just concrete, asphalt, steel. There's not technically a lot to it, but when there's 100,000 square feet, there is some things to obviously design and figure out, especially your unit mix based off of the area and the demographics and whatnot. But so that takes about 8 to 12 months. And then after that, once it's designed, we got our permits, we go and get a contractor on board, they go and build it. Our original construction timeline was 12 months, but in reality, they should be able to build 100,000 square feet in like 10, 11 months. So that's where we should end up, that July, August, give or take. And then after that, it's filled up with a bunch of tenants and, hopefully make a lot of money.
Yeah. Yeah. Cool. And you're looking to potentially acquire more of these projects, right?
Yeah, we have another one in the design. Well, it's fully designed. We have a contractor on board. We've selected one. We're just going through a permit process right now, as well as financing for another one in Florida. So that's maybe, I don't know, an hour and a half, 2 hours south of Tampa, give or take, on the Gulf Coast. So that one's a bit bigger of a project. So it's still about, it's 140,000 gross square feet. I think there's like 105 net rentable, but it's broken up into just over 1,000 units. So, but it's all 100% climate controlled. So there's 2 buildings and it's basically all of it is climate controlled storage. So hopefully that one will break ground, early this summer. And then again, that whole process repeats.
Yeah. Cool. Speaking of Florida, so you said you have 2 short-term rentals in Florida. Which areas are those in?
Cape Coral.
Cape Coral. Okay. Was that hit by the hurricane?
Oh yeah,
recently.
Yep.
Yeah.
Yeah. Well, not the last hurricane that came through. I think that was Hurricane Ida or whatever it was. The one before it, Hurricane Ian, that hit Fort Myers, that came right through Cape Coral. So
okay. So was there any damage to your properties?
Not like nothing crazy like that. Fortunately, like so it was weird. We, like, being Canadian, we normally, I shovel your driveway with snow and stuff. Never in a million years I would have thought I would be dealing with a hurricane, but here I was. So so Fort Myers had the majority of the damage, and then Cape Coral, obviously had some damage. But after, like, I was very impressed. Like, we went down after the hurricane and I was like, it looked like World War III. Like, there was, like, especially in Fort Myers, like it looked awful.
Yeah.
But then we went back a few months later and I'm like, oh, other than some crooked trees, like you wouldn't really know, I guess. Like, if you didn't know there was a hurricane, you probably wouldn't really clue into it. In certain areas, like Fort Myers, different story. Now it's coming back. They've cleaned up a lot of it. So it's, it's definitely coming back. But our properties, we had, other than a couple shingles flip up, some soffit, we had a palm tree end up in a pool. A couple other palm trees fell down, but like, we didn't have any, we had water up to the door, but never inside. So like, it flooded up to the door. Like, so like the whole road in the front yard, ditch and everything was water. But other than that, like, our one house looked really bad, but it was because the neighbor's roof blew off and was in our yard. So we just had shingles all over the place, but that's it. So we were pretty fortunate, I guess, compared to a lot of other people. A lot of other people were in definitely worse scenarios.
Yeah. Yeah. And is that why you said things slowed down? Is it just like not as many people have gone there since the hurricane?
See, that's the thing. We still get bookings. Like, our houses are booked, but we've just had to lower the rate to get those bookings. So I feel the demand has dropped partially, and this is just my thought, I have no clue. Partially the thought is, why would we go to that area when there's then when the hurricane would hit? Like, everyone's got a perception of like it's ruined, when to be honest, Cape Coral and even majority of Fort Myers now, like you can still go to the beach, you can still go to restaurants, like everything's back to normal.
Mm-hmm.
So I think immediately, actually, it's funny. The hurricane year, we did really well, but that was because we had like workers that came down to stay at our houses as well versus like vacation people.
Right.
But now that that's dealt with, now it's, back to people just going on vacation or, visiting family or whatever. I feel that the reason it's slowed down more is I feel like, the economy and everyone's, tight on their money because, rates and everything else.
Mm-hmm.
So I feel like that's a bigger part of it versus the hurricane. But, again, I'm speculating.
Yeah, fair enough. And also, I recently spoke to someone else about this, but the days on market has increased quite a bit, right? For people that are looking to sell their properties down in Cape Coral.
Yeah, I think it's everywhere, to be honest. Like I sold a triplex recently in Brantford and it took over a year. So I think everywhere, like just because rates have gone up. So I think they need that transition time for people to realize, like, if somebody's buying a house and they're paying, double the interest rate, they can't pay you what you thought it was worth because the mortgage costs and all that other stuff, right? So I don't think Florida and the states overall is impacted as much with rates purely because the most people have 30-year mortgages. So if you had a 30-year mortgage at 2%, you're laughing, right?
Mm-hmm.
So, but yeah.
Okay. Maybe we can just move on to the final point, which is personal development. You said that was a big deal for you, that you're focused on that. Tell us like what programs you're involved in or what personal development means to you.
Yeah. So like, I guess everyone wants to, make a lot of money, go down this real estate investment road and, buy all these houses and be, the next Donald Trump kind of thing. Right. But in reality, like to get into business and to do all this investment stuff, it, from I guess the average person, it seems, it's difficult, right, for them to kind of understand all that. So the personal development stuff, I feel like anyone who's doing like any of this real estate stuff or business stuff, they, you have to be in the right mindset, in my opinion. Otherwise, like, you're just setting yourself up for failure. So I've read a lot of books, and I think it's funny when you read these books, like whether they're, David Goggins or Ed Milet or whatever these, Jocko or whoever, like there's all these books about personal development and, being disciplined and doing all these things. It's funny because all of the books like that I've read, and, there's probably a dozen of them, they all have similar points in it. So it's interesting where it's like, you can tie in some of that discipline and some of those development skills that they talk about in these books into business and entrepreneurship. So that's kind of why I feel like it's pretty important. Like I started running the last few years, and if there's a problem that I'm dealing with, it's weird and it sounds corny and stuff, but like if I go for a run, I can mentally like gain some clarity to figure some stuff out. Like even if I'm listening to music or a book or whatever when I'm running, like I think clearer, I guess. So it's just weird, I guess, correlation, but the whole personal development stuff and, being in the right mindset and making right decisions and cutting out the negativity in your life and all that stuff, like all of that combined, I feel is a big improvement on like your overall happiness of life. And then you combine that with, investing in real estate and stuff. And then I feel like that's where, you can really take off. So yeah, that's kind of where I was going at with like the whole personal development stuff. But the other side of it too is like we're part of, I guess, a big mastermind group of other like-minded people. We go to these events. I think there are 3 or 4 of them a year. And, you hear from speakers who are in the industry and you hear from other people that are in the industry and they, you got guest speakers talking about, awesome stuff and, gets you motivated and amped up. But then you're just like, for those couple days or 3 days that you're there, you're talking with other investors and other entrepreneurs, and you come up with different ideas. And if you're talking about a problem that you're dealing with, usually there's somebody in the room that can help you, or vice versa, right? So it's just good to, stay on top of that side of thing, because, I think that's kind of what really helps everything grow ultimately. Yeah.
Are you able to share the mastermind group that you're a part of? Like, is it a local group or is it a US based group?
No, it's US based. So we joined it's called Legacy Family by Tim Bratz. So, I highly recommend it. We've been part of it for about a year now, maybe. But yeah, no, there's, I think we're the only Canadians in it. So we joined it purely because, we're investing in the US, and I wanted to be part of a group where there's other US entrepreneurs and investors to, basically get some more information, because we're investing in the US, right?
Yeah.
So
cool. Awesome. Well, there's a lot here for people to digest. Is there anything you feel like we missed? Any points you want to touch on?
No, I think that's it. Like I don't know, ask away if there's anything else you want to ask. I got so much crap in my head that I might miss things, but I'll try to be open and honest. And if I can help people, I'm happy to do it. I know going through my entrepreneur investment journey, I've reached out to other people always asking for help or guidance, or just, something to, it's nice to have a second set of eyes on something, whatever. And when I was doing it, everyone else just, I think it was during the era of everyone becoming a coach, right? Now everyone's just coaching everything because they can and people pay for it, right? So, but when I was doing it, like when I needed help, I guess, I would ask other people and whatever, and not everyone was open to help. Like they wanted to, like, oh, if you want help, you pay me and then I'll talk to you, right? Where, I don't know, I think what goes around comes around. So I don't mind helping if somebody needs help or asks a question or whatever. If it doesn't take too much time and I can answer the question and help them, I feel good as a person. So, obviously if it takes longer, they need more time or whatever, then obviously it can lead into other things. But, if there's no skin off your butt to help, it doesn't hurt. So
yeah,
if anybody does need anything, reach out.
Yeah, that was the next thing, actually. So if you just want to tell people the services that you're offering and the best way to reach out.
So I guess there's a couple things that I'm doing. If somebody's just got questions about random stuff, the easiest thing is to message me on Instagram. My handle, I think you'll probably put it in here, whatever, but it's nick.nvd, I believe it is. Something like that. But I'm sure if you search Nick Van Dyke on Instagram, I'll pop up. But I started a community. So it's a small community right now, but basically it's called NVD Community. So if anyone who, wants to join, we have weekly phone calls. And basically it's a small community right now with a bunch of investors in there. And purely it's for people to ask questions, bounce ideas off of me, bounce ideas off of anyone else in the group. And we just have weekly phone calls. So if somebody's interested in that, they can reach out. And then the other thing on top of that, we're actually in the process right now of creating a course for Canadians who want to invest in the US doing self-storage developments specifically. So we're in the process of creating that, but there is a ton of information. So it's like the logistics to actually get it all recorded and create the course is a lot bigger than I thought it was going to be. But that's also in the works. So if anyone's interested in that, reach out and I can keep you updated, I guess. So
sounds good. Well, Nick, thank you for sharing all this, and we'll definitely include all the information in the show notes.
Awesome.
Appreciate your time and looking forward to staying in touch and seeing how things go in the US for you.
Perfect. Well, thanks for having me and appreciate it.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.